Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we discuss all things high yield investing, options, as well as futures trading. Welcome if you're new. I wanted to give just a little bit of background on the channel. I took a significant chunk of my net worth. I have put it into what I call a $500,000 experiment using some of my own capital as well as margin to see if I can live off a portfolio that will pay my bills as well as maintain and pay down my margin over time. So the goal is to have success with this, right? And I think I've said it before, one of two things will happen. I think it will either succeed and I'll keep adding to the strategy, or if it fails, we'll go back to the drawing board and try something else. So if you like what we're doing here, please like and subscribe to support the channel. Nothing here is investment advice, so please do your own due diligence before making any investment decisions. So what I want to focus on today, I want to talk about how I hedge cash flow life to the downside. We're coming off 3 straight years of bull market and really, I think, significant gains the past 3 years. I think 2026 could look very different than what we've seen in the past few years. So I want to hedge this portfolio. I want to make sure that, if a market crash does come, and they do come, right? That I don't get wiped out in the process. So a few things I'm doing are I bought puts. I bought another long put on the Qs yesterday as well as SPY. So just to kind of take a look, I've got 2 leaps put options on QQQ and SPY. Both of them expire December of 2027. Just to let's click on the SPY. We'll pick on this one. And market corrections don't necessarily scare me. I think corrections are healthy. I think they're part of the investment process. I would say if you can't handle a correction, I'm not sure if one should be investing in that situation, because they will come, right? Your 10, 20, 30% corrections are normal. They are healthy. They get out the excess and toxicity out of the system. So it's the big crashes, right? The 1929s, the 2008s, those are the ones that I want to hedge for. So what I do, I typically buy long dated put options, and I buy them about 20% out of the money, meaning about 20% lower than what their market value is. And the reason I do it, I want to save on premium that way. Okay. And what I like about this tool on Robinhood here is that I can go to simulate my returns, right? And I can actually just see, okay, if we had let's scroll this. And since it's 20% out of the money, you won't really see any significant returns on this until we hit about 20% or lower in a market crash. So if I just went down here, let's say we had a 50% market crash. The SPY, what would be nice about it, these go up hundreds, even thousands of percents, right, in a market crash. So I think they're just good, huge downside protection. So if I go to 50%, just scroll down here, we'll go right around 50. You can see that, my return on a roughly $5,000 investment into these puts, I get about $36,000 back, right? Hedging to that downside in a significant market correction. So I like these long puts. I mean, you can buy puts of any duration, right? You can buy them for the day, you can buy them for a week, a month, or however long you want. I go with leaps because I think if we do have a significant downturn, which I think one is coming, that's my personal opinion, that it will probably happen over the next couple of years. Right now, just an update, the yield curve inversion, we're in one of the longest, if not the longest yield curve inversion in history. Not a perfect indicator, right? But usually crashes do follow yield inversions, right? When the curve re-steepens. So something to be mindful of. The CNN Fear and Greed Index, another index I like, just to kind of it speaks to market sentiment, is back to neutral. We were at extreme fear and fear. So, I think this market will probably go sideways this month, but I do want to be mindful of the downside because I do not see much to any value in this market right now at this point. So my long puts, this is one way I hedge. Now, I've mentioned in past videos, I'm going to probably bring over another $100,000 into this strategy in January. And my plan, I'd like to buy one more long dated put on QQQ. I want to buy another long dated put on SPY. So I'll have 3 buys on each, just to hedge much more of the portfolio. What I think I'm also going to do is buy back into YQQQ. And what I like about YQQQ is that it's an inverse, 1-to-1 and of the NASDAQ. So as the NASDAQ rises, it will fall. As the NASDAQ falls, it will rise. And it's going to pay weekly distributions as well. And I see it more of a play on short-term volatility, more of a correction hedge, because it will lose some of its upside if the market does go down due to the income that it produces, right? So it sells covered puts on the NASDAQ. So you're going to lose some of that upside anyways. But if the market does sell off maybe only 10 or 20%, my long dated puts may not do great, but YQQQ should help the portfolio hold up a little bit better as well. So I think I'm going to put $50,000 into YQQQ, buy another long dated put on the Qs and SPY, which will be another roughly $5,000. And then I'm considering doing $10,000 into Salty SLTY, which is a short option play just for high income. And then Robinhood has since raised Ulti's margin maintenance to 70% since they did the reverse split 1 to 10. So I may not do Ulti. I may do, I was exploring KYLD, one of Curve's high income ETFs. Does not pay as much, but it has had decent performance and far less NAV erosion than Ulti has. So I was considering putting $10,000 into KYLD and $10,000 into SLTY and let those play out. Just pay income, pay down the margin, and let those NAVs and holdings play out how they will. Some other hedges, though, are TLTW, right? TLTW is the iShares 20-year bond, 20-plus bond buy right? So they're buying bonds of 20-year durations or longer and selling calls on those, generating income. I think it's a great deflation hedge. If we do go into a deflationary downturn, historically, TLT or the long bonds have done well. So I like that as another hedge. SGov, that's another 10% of just cash, right? So I think TLTW and SGov both each about 10% of the portfolio. I think that's another nice hedge to the downside also. And if the markets do sell off significantly, I wouldn't mind deploying some of that SGov cash back into the strategy as well. Gold, right? I've been wrong on gold. I thought for sure that gold would be around $3,500 right now. After that October sell-off, I thought, when gold dumps, it dumps pretty big. And I thought, gold would be about 3,500 right now. I thought silver would be in the low 40s. I was wrong. So the fact that gold and silver are sitting where they currently are, that's another just kind of, warning sign, right? Flashing red to me that something just isn't right. As gold goes up, typically things aren't getting better. Let's just put it that way. So sitting here all-time highs, I think that gold is a good hedge, even though it is pricey, right? It wasn't what it was even a year or two ago. So gold is another way I offset some volatility when markets turn down, as well as real estate, IYRI. It's had a very low correlation. REITs have had a very low correlation to what the Qs have done over the past few years. Far underperformed QQQ. So I like that, because if and when this AI bubble does eventually pop, I think IYRI and the REITs will hold up rather well, right? I think they've got a lot of upside. But again, if rates do keep rising, which I think they will, that doesn't usually bode well for the REIT space, the real estate space. Just some updated stats. Currently sitting at 128,531 in margin. I had to pay some bills and I bought 2 more puts, so that bumped my margin up. I think what I'll do also when I bring that 100K over and I've used up about 75,000, I'm going to pay that margin down. I think closer to right around between 100,000 and 110,000, and kind of keep it there to start off the year. So just bring that margin down a little bit, pay that down. Options collateral did go up, so my margin buffer did go down. I was sitting right about 63% over the weekend in margin buffer, currently down at that 58 to 59% range. Again, I do not like dropping below 50% margin buffer. And the reason for it, I sold another put on Coca-Cola. I sold another put on PG&E, and I sold another put on AT&T. So just generate a little bit of cash there for the portfolio. These are all these puts that I sold are expiring the end of this week. Hopefully worthless, right? But if they don't, if some of these puts are assigned to me, I will just turn around on Monday, and I will sell covered calls on each of them to generate more income. Again, the goal is to not really hold these long term. I just like some of the utilities and blue chips because they just offer more stability to the portfolio. They're dividend payers. So if I am holding the shares, they're going to pay me dividends along the way also. And having that heavy tech exposure through the Qs, through even S&P 500 now is very tech heavy, as well as WPay and YMAX. I like to just have those just for a little bit more as a volatility hedge. So that's where we currently are. I think it's important to always hedge your downside. You know, markets historically have trended upwards, right? They've gone up, but you know, they don't always go up, right? And it just takes one big crash, I think, to wipe a lot of investors out. So it's important to be mindful of, I think, allocations and, you know, staying long, but also having that hedge as well. And I don't hedge 100% of the portfolio. You can. I know some people hedge more than 100%, right? They think that a huge crash is coming. That's fine. I like to stay between usually 50 to 75% if I can. So I'm going to see if I can get that target come January. Hope you got something from today. Thanks for being here. Enjoy your day.